I think if you look at analyst estimates, bottom-up estimates for the S&P 500, you will find that they basically haven't come down very much at all. And that's an important point because analysts have never forecasted a profits recession from a bottom-up point of view. What you're starting to see is small-cap stocks earnings estimates erode, mid-cap stocks estimates erode. That's been reflected in some of the underperformance of small and mids, but for some reason analysts believe, as they always believe at this point, that large caps are immune, and I think we're going to find that that's a mistake.
Professor Siegel, what do you think about this market right now? Would you expect it to finish the year higher or lower, and why?
Well, first, it shows that the Fed has to do more work. Inversion has come back. I look at the 90-day Treasury bill and the 10-year bond. It's inverted. The Fed funds rate in the 10-year is inverted again. Even if the Fed drops 25 basis points, the Fed funds rate is above the 10-year. It should not be that high. So I think it's a sort of a strange market. The data's bad enough, so now people think the Fed is going to come to our rescue. Hooray, I'm going to buy stocks. This quarter looks like 1.5%. Some analysts are marking this quarter down, and I say this, I'm taking the third quarter that we just finished down to just 1%. So we have suffered a slowdown. The Fed does have to move. I thought it should move 50 basis points before. And even though there's a lot of doubting Thomases there on the FOMC saying, oh, everything is fine, I think a lot of this underlying data does not say so. I am also going to be certainly awaiting tomorrow's payroll data.
So, Richard, what to make of a market where you have fundamentals deteriorating, and as Jeremy just sort of pointed out, you've got a lot of people anticipating a Fed move is the reason why you want to buy. Is that typically a good time to actually think about buying?
Well, David, you get a little tug of war here between the deterioration of fundamentals and the Fed easing. And generally in the very late stages of a cycle or the very, very early stages, the fundamentals deteriorate too rapidly relative to the Fed. And I think that's kind of what Jeremy was just describing, is that you've got some fundamentals that are deteriorating, but you've got some hesitancy on the Fed to still ease. That's perfectly normal. That's what the Fed goes through every cycle. And it's one of the reasons I would argue that the Fed is often a lagging indicator, way behind the markets and way behind the yield curve. And I think the yield curve is telling you that there's still more weakness ahead.
Stephanie, we've had so many people who've come on our air just in the last couple of days and said, oh, Tina, there is no alternative. That's what's categorizing this market right now. That's what's going to continue to fuel stocks. How do you see it?
That's part of it, for sure. I think our fundamentals, even though we're growing slower, if it's 1.5%, maybe sub 2% growth, there's still some earnings power there. And I still believe that their margin story still has upside. That's pretty controversial. Most people think margins, especially in the States and the U.S.
So why do you believe that?
Because I think these companies have done an amazing job at restructuring, and they're going to continue to restructure, and they're faster in terms of making change and adapting to change. And so I think they're much more focused on profitability as opposed to like the European companies, right? We always say, oh my gosh, their margins are like half of ours. However, they can never really get them up that much, and they're not as active in doing so. So I still think that there's good earnings power. It might be slower, but I don't see a profits recession.